All right, good afternoon, everybody. And for those who are attending the second time around, now today we're going to be looking into the aspect of trading strategies. I was asked to be able to give a talk for, of course, people who are just coming into the market for the first time. And today I'm going to talk about how to better understand making decisions in the market. What are the foremost things that people use to be able to make decisions? How do they create some sort of plan of activity? And what are the common frames of thought or strategies that people use to buy and sell stocks? So I'm not just going to be talking about fundamentals or technicals. It's going to be little pieces of everything, but at least you'll be able to get a sense of what is more appropriate to people who are coming into the market today. Now, of course, the advent of the online investor, generates a lot more activity for people at the end of the day. And of course, a lot of the control has been thrust into their particular type of direction. And a lot of people will also be looking into the fact that trading is going to be a very, very necessary thing. But I think trading is something that you will learn little by little as you become more experienced in your capacity to be able to deal with the information, especially if you're going to be dealing and trading in a very, very quick aspect of it. So today, let's have a look into it. And again, for those of you who are joining me for the first time, my name is Juanis Barredo. I'm the Vice President for COL Financial. I've been the head of the technical analysis department of our company for better part of 15 years now, and part of what I do is time markets as a specialty. Now, trading is a very interesting skill. It requires some learning. It requires a huge degree of discipline. And in your ability to carry out a particular trade, you're going to see what the elements of that trade is going to be. And you're going to see that it's not just as simple as just walking into your market, looking at the ticker, seeing what's moving, and then go blasting away with your two guns. I mean, it doesn't work that way. It has to be some control mechanism inside here. And it has to be able to push that little by little over time. Now, I think it's very essential that when you come around to be able to determine what the aspect of that is, there is a certain mindset that you have to be able to take up. And remember, trading is all about structure. It cannot be just a whim. Things don't just come out and happen on their own. There has to be some sort of set of guidelines that you're going to have to trust to be able to put into order to get your deed done for the day. And so in aspect of what we're going to be learning today, we're going to talk about what that trading discipline is going to be like, and we're going to have to understand how do I plan a trade towards the course of the day or the course of the week or whichever way that you'd like to be able to push your order time sets. Now, trading is all about three sequential parts. The first is preparation, followed by methodology, and of course the last part, execution and management, if you will. And so what you have to learn first is, how do you prepare your mind? How do you prepare yourself? How do you prepare the ability for you to look into what stock to buy? And here we're going to have to be able to deal with some pieces of information that many of you are going to have to get acquainted with. And we'll talk about looking in the big picture first. And after you look into the big picture, you also want to be able to understand what are the fundamental values that qualify your stock picks. You're not just going to buy anything that looks good on the technical side, but there has to be some sort of element of quality in whatever it is that you guys would buy. Methodology comes second, and this is going to ask you now, all right, so you finally found companies to buy. What do you do now? What kind of trading technique would you use? Is it the kind that you're going to buy everything all in one go? Are you going to space it out over in time? Are you going to buy it in short bursts? How do you put it all together? So there has to be some sort of methodology there too. Third, we're going to talk about, of course, execution. And execution simply means, all right, you got your plan of activity for the day, go after it. And execution should be very easy. Right? Execution. When you generate a trade, the very first trade you make, that's the easy part. It's selling or getting out of a trade that's more difficult. Why? Because executing an order is a simple process. When you don't have a stock position and you want to build one, you will say yes to it because of one basic need of you, the need to be greedy. That's why you buy stocks, right? But when you exit, not only is there greed, but now there's greed, fear, senseless, wanton abandonment, right? Sleepless nights, you name it, everything's there on the exit. And believe me, exiting a position is 10 times as hard as entering one. And so exiting a position is an art. while entering a position is a science. And as much as we try, we're going to have to somehow put some sort of discipline into the exit strategy. So I hope in the 1 hour time that I have to speak with you that I can come around to delegate some, although I can't. I wish I could have taken a greater chunk of your time to do so. I'll try to deal with what we can. So what is a trader and what is that life all about? You know, Hollywood has a way of popularizing things, and our friend over here started it all. Greed is good. And in that ability to understand that greed is good, Gordon Gekko over here, popularized by the movie Wall Street. And this particular feature got everybody interested into stock markets. They said, wow, what a guy. How did he put this all together? And people are amazed at what they managed to be able to pick up from this particular movie. But I will tell you the reality is it's not really like that. All right? And even more popular, I think, in recent days, but perhaps not in long-lasting one, came out this guy. And, well, I was entertained by the movie. And that's about all I was, entertained. And I'll tell you, I mean, don't expect anything short of what you saw into this movie to manifest, although they say that these are based on actual accounts. But this is not a trader's life, right? The first movie, there was some semblance of truth. You're talking about the market guy who's accumulating a certain stock and move it. We call that a market mover, and eventually he became a manipulator of sports. But this is just completely very different. This is not what I'm teaching you today. So if you came here to know more about the ins and outs of the Wolf and Wall Street, the seminar's there in the other room. All right, so in lieu of what we're going to be looking at today, we have to talk about the nature of the beast that we're going to cover, and that is the nature of the beast who's sitting in that chair right on you. If you are a trader and you decided to take that as your skill and as your profession inside, then you're going to have to build a whole set of skills that's going to entrust yourself with good guidance. And the job of a trader should be quite simple. You're going to be proposing yourself that there has to be a set of rules that you're going to follow to enter a market and to exit the market. And you always have to be able to rely on those things. More especially when you see markets come to the point where it seems to be, wow, everything is just breaking loose and you don't know what's going on anymore. You have to trust your system. You cannot leave it to the human being and let his emotional side come in and take control of you, because you will never make money in the end. So the strategy is all about carrying out that discipline. And if you're here to learn how to time the market as a trader would do, if you're here for trading strategies, I would assume you're looking to be a trader. And your job as a trader is to be able to erect or to put together these set of rules that will govern your activity. And so you will set apart between an investor and a trader. An investor is someone who will buy a position because they believe the long-term prospect of that business is beautiful. And yes, and rightfully so. And if you had held that position through and through, I mean, you can come inside and make a good-sized amount of money. Call it wrong. Buy a wrong stock. Something happens to it, and you don't manage that position through and through. All the waiting time you've done could be flushed down the toilet very quickly. So if you want to be a long-term investor, don't think that it's a hands-off policy. There is some sort of maintenance that's still required for you to be able to carry your position. You just don't just believe it and just say, oh, in the name of the Father, and the Son, and the Holy Ghost, and I hope I make money. No. You're going to have to put this activity together. And if you notice, a trader has to do two things. He's there, yes, because he wants to generate better profit, but he's also there because he has to manage his risk very tightly. And that combination of the ability for you to go after profit and to be able to be wary of risk is what a trader is all about. Okay? And that's very far from what Wall Street proposes. Now, in our ability to understand the first chapter of activity of a trader's life really is preparation. And maybe some of you don't want to do this, or maybe you're too lazy to do it. Maybe you've had a hard day and you have no time to do it. Then more likely, if you keep saying that and you don't have time to be able to do it, then you shouldn't be having any time to become a trader, because you have to have preparation, right? Remember this, luck, right? Luck can come to you. But luck favors the informed mind. And what that statement says, that if you want to be lucky, why don't you make sure that the forces of being lucky are in your favor. If you know what you're doing, all the more all these prospects will be with you. They will just not fall out of the sky on God's grace. Of course, if some of you were in my earlier seminar, I talked about the priest, and that was completely something else. And so we have to understand that the preparation is this. And if you notice the statement there, it says that if you know the enemy and know yourself, you need not fear the results of 100 battles. Very important thing. So that means the preparation inside will render you successful through and through. Now, we might have some lapses, we might have some losses. That's part of the trading instinct, and that comes as part of the whole ball game. But we have to make sure that the more success we have and the more effective the outcome will be into the longer term. So, step number 1. Don't you ever just leap into darkness. You must know the big picture. If you're going to come into a marketplace and you have no idea what's about to happen, you have no business being there. You need to understand what's going on. What's wrong with your economy? What's wrong with your country? Or what's good with your country, for heaven's sakes? And notice what that mileage is going to be. Because if you don't understand it and you can't get a sense of what's going on inside it, then any action you do is just one gigantic guess. So you must know what the big picture is. And so in a very, very short ability for you to step up in that, just ask yourself one question. Do you feel that the environment that you're currently at today, is it a, if you'd like, bullish or bearish one? Or maybe to translate that into more English words. Do you think that we are in a period where there's a lot of money available, where people can tap into that cash, build business, and generate much more enterprise from it? Are interest rates incredibly low? Because if they are, then people will use that cash to be able to build more business. Do you think that's the environment that we are in today? Yes. And thus, in looking at that particular prospect, we're clearly not in the second one. And we are not into a bearish sentiment. So that means we don't have to be too defensive in markets today, because we should be a bit more aggressive in markets today, because the time and signs are showing that that's where we are. And the Philippines has shown that mileage. Right? If you want to be able to have a look more into the details of that, you can see clearly we've got good economic results. Interest rates remain to be quite low. Cash flows are good. OFW money is very solid, and etc. We've got a huge amount of pluses rather than the negatives that you see around you. So posturing in the market should be a bit more aggressive. You don't have to be too scared of what you're seeing right now. Second, you have to make sure that if you're about to be able to invest in companies, they have to be good to great companies. We're not here to invest in the mediocre. When I say the mediocre, you're not here to invest in an ordinary business. You're here to invest in a great business. And because the great business is the ones that will generate a phenomenal amount of movement. Because there are two things, please, as a trader, you understand, there should be two things that you should be concerned about. Two things that could incredibly jot up a price tremendously. One are fantastic fundamentals. When we say fundamentals, what is the quality of the business? Is earnings becoming bigger? Are there more qualities of that? And the other one is a good story. Might not have any earnings yet, but there could be a good story. People might love it so much. And because of that, you could have a double D. Reaching 10 pesos in a matter of weeks, for heaven's sakes. So, do understand that there could be these prospects inside, but remember, without the solid backing of fundamentals, you can have a double D, but that could invert itself one day. Because if it's not solidly founded on the basic structure fundamentals, it could become too expensive, and you will see that thing pull back one day, and it could be also quite scary if the fundamentals don't justify them. So it's a sense that you would have something like this. When you look into a business, have these qualities. You might want a business that is in a growing industry. It has earnings that you can see and you can come around and say and try to estimate. That's why we want it to be visible. We also want to make sure that management is solid enough. These people are running the business well. You know, you can be an ordinary manager, and in an economic times of robustness, any manager might just look so good. But manage your business in a crisis, and then you will see the difference between a good one and a lousy one. We want solid managers in a business. We also want what we call superior products and services. Our GEMs are spelled with 2 S's. And when we say that we want that superior product and services, there has to be something really budding into a business that is lasting. It cannot be a one-time wonder. And finally, we want something to be able to hook onto and make sure we have no surprises tomorrow. And that means that the business has to be able to make sure that its finances are in order. It has to have a strong balance sheet. Now, I'm not here to give you a lecture in fundamental analysis, but I just want to show you the more of the qualities you see of this inside a company you're about to buy, the more successful investor you stand to be. Now, fundamentals should be used to qualify your stock pick. Fundamental analysis is not a timing tool. All right? And so you will make sure that the environment around you, the companies you're about to pick, are all solid. And you're going to say, all right, all this, or at least 3 or 4 of that's inside my business. And it's because of that that I can come around and say, this company eventually will move up anyway. So you have to be able to plan for that and make sure that qualities are there. Now, as you come around to be able to pick up these phenomenal gems, you have to also ask yourself the question, is this company expensive or not? Now, in today's online environment, fair values of corporations or the target prices of companies or what they're really valued at are much more visible today than they were a long time ago. And fair valuations can be found, of course, in your broker sites if they do have a research team. And they will paint out what the value of that business is. And it works very simply. If the fair value of a company, let's say, is 10 pesos per share, and your price of your stock is trading below it, then you can easily say that the company is cheap. And the cheaper that valuation is, then the more attractive it should be for you to be able to pick up. And so what you want to get a sense of this is that if there comes a point where the price of your stock is just so astronomically higher than your fair value, then it's time for you guys to just wait for the next better opportunity. You don't have to come whacking into your stock when things are just too pricey as of that moment. In fact, some people may use an overpriced situation to be able to lighten on their position and then hopefully buy it back when more reason comes into your stock. And believe me, there will be reason. And although, yes, markets do get excited once in a while, there will be that rationality that will come and it will push your stock back eventually. Believe you me, don't think that your stock will climb up forever. It takes time to do that, as you will see later on. Now, in our ability to be able to generate that particular type of decision making, I want to be able to propose to you that if the stock price, for example, is already trading above or way above its fair value, please step back. Right? Allow that to control that. I mean, that should be able to take you off making any major decisions in the error side. Because it's only when you buy prices that are too skyrocketingly high that you will be subject to huge volatility declines. So you want to make sure that you know that. Just to give you a sense of it, for those who understand how to come check market price, you can look at it in this column and then compare it with your fair values. So as long as you see that prices are clearly much lower than what you have on this column over here, then you can say your company is cheap and that is a qualified stock for you to eventually buy. Remember, fundamentals will qualify your stock, technicals will teach you how to enter. So technicals are the timing issue, and we'll go to that in a little bit. Now, you look into the company, it looks cheap enough, validate what you read, and you validate it by reading reports. And when you say reports, the job of a trader is to be able to come inside and sort through the pieces of information and make sure that he understands that the business is about to be able to pick up is a lasting one, it's a good one, sensible one. And you don't come out and tell a story about something that might just pass. Be careful when you value certain types of companies, particularly technological companies whose technology may run away. Have you guys heard of a company called Globe Mackay? Maybe guys my age or more might know. But there was a company once called Globe Mackay. This company was in the business of sending telex messages across the world. Anybody know what a telex is? Again, anybody my age or older will probably know. A telex used to be the earliest form of a fax machine. So if you wanted to send information across the world, you would digitize it, send it to this contraption that would send it to the other side, it would recompose that, and then they will send it to the particular recipient. But of course, they don't have these machines today because fax machines made them, or random them, an old technology. And so Globe Mackay, that was their business. And immediately when the fax machine came out, the business of Globe just turned down like this. And so Globe Mackay says, I can't run my business anymore. So they changed it. And so before they went bankrupt, they decided to be able to test a new technology called cellular phone technology. And when they decided to test that technology, they had to spend a huge amount of money, and they did a partnership with Singapore Telecom, and these guys generally aided in the transfer of technology, and eventually Globe Mackay said, all right, we'll take a chance, we'll use your technology, and Globe Mackay one day said, we're also changing our name, and today they're known as Globe Telecom. From a company that was taking so much losses, at least when I started in the industry, they were just taking losses every year. And today, they make billions in profits. And so, you have to qualify what happens. It's only when that change takes place that your attention should be in there. So the minute you're looking to buy a stock and you don't even know who owns it, you don't even know if they're making money, you don't even know what's going on in the business, and you don't even know if they're profitable or not, what business do you have there? You shouldn't be there, even if you're a trader. Because all it takes, even if you're a trader, you might be fast enough, all it takes is one mistake. CEO runs away with the money, you're dead tomorrow. Okay, so please, let's take that risk out. Know your company, and I think that should be able to give a good cushion in case things go wrong. Next, we talk about methodology. Now, methodology is how you're going to put things together. And that means, I like this company, good valuation, great fundamentals. How do I buy this guy? And so when you accumulate stock, there are various ways to do it. You could go into trading, which is much more faster. You could just buy a stock and hold it for a very long time. And so let's try to be able to look at some of these propositions and see what we have to understand. Remember, you have to look at the plan, because you cannot just come inside and I feel like doing this, or I want to do that because I just instinctively do this. And you have to understand why it's very important to have a methodology. If you do something right and you make money, put it in your pocket. But now how do you repeat that success? Let's say you just did it because it was, what's the word? Chamba. How do you repeat that success? You cannot. But if you have a process, you have a methodology that you can repeat over and over again, then you can repeat success over again, and you can contain any risk that you have. So it's essential that you come around to be able to understand that. Now, in our ability to look into it, I guess one of the greatest challenges people will talk about in the world of buying stocks for the longer haul is two particular types of strategies. One is called the buy and hold strategy, and I'm sure you're all familiar with that. When you say buy and hold, that means you're going to be either purchasing your stocks all in one go, or you're going to be accumulating all in a period, and you're going to say, since this company is going to be a phenomenal big company in the next 2, 5, 10, 20 years, then I'm just going to pick it up and I will just watch and see how it goes, and of course earn the money as the valuations on the business starts to expand. And so our capacity to understand that is that, remember, this is more longer term in its ability to do that, but it's understanding that you have to sit on the position for it to make money for you. Now, being a trader is difficult, because having to be able to press that eject button sometimes because you feel like so could actually be very difficult for you. Can you imagine if you bought a stock like DMC, where DMC was trading like below 10 pesos one at a time, then it went up to 11, then it went up to 15, then it went up to 20 if you took your profit there, then it went up to 25, then it went up to 30. By that time, you're banging your head on the table and saying, how come I'm still not there, and I let it loose, and you didn't want to buy it back, then it went back to 35, then it went back higher, then you're really banging your head in the table, and eventually you buy it at a really high price, and then it goes down. And that's what we're trying to avoid, right? So we want to keep ourselves in bigger part of that trend, so to speak, as we have to be able to do it. And I know it's very difficult to do it, but please try to understand that the biggest amount of money you'll do is having a position in that market for a long time. You can actually, remember, you can have the best of both worlds. You can have one part of your position sitting in a longer term, and you can have half of it in being traded, just in case you really want to scratch that itch that's taking place in your hand. But please try to have a position that's a bit more longer term in orientation, because that can make a lot of money for you. Now, the advantages and disadvantages of that is, well, it's easy to understand because, you know, it's easy to implement. I mean, just buy it and hold it. I mean, how much thinking is involved there? You don't really need to time the market, because you're just going to be buying it and holding it for a lengthy period of time anyway. And thirdly, it's very efficient, because I'm not going to be turning over a buy-sell. It's going to be less costly for me in terms of commissions and any transaction fees. So it could really make, potentially make a good amount of money. The disadvantage of that particular system, however, is one, I mean, you open yourself to heavy losses because let's say it turns around and it heads back down. If you have some sort of fail-safe system to protect you, that means you could literally rip right open the floor. And so be careful about this. I mean, we have to be able to manage that somehow. And you're subject to risk tolerance. And what I mean is it's easy to say buy and hold. So if you guys manage to even pick up, let's say, Double Dragon at 5, and if it went up to 7, weren't you excited enough? Didn't you want to take enough profit already? Aren't you saying that you might even lose that profit one day? And then it happened to go to 750, you say, all right, that's it, you sell it. And then it goes to 8, and you said, oh my God. Especially now at 10, oh my God. And so what you want to do is you have to put some sort of allowance for that type of activity to take out. And the problem is this, if you buy a position, and let's say it takes really long time to advance in terms of appreciation, what happens if a better opportunity knocks on your door? And you have a better stock that you have to buy. But I'm holding this in the long term and all my cash is devoted to it. How do I move? But remember, I don't want you to be so mobile in your position, but you have to be able to make a certain amount of allocation to your stock position so that you can put in a certain amount of freeness for you to be able to diversify. A typical trader should have in maybe 3 to 5 stocks maximum. And that's your world. Force yourself in that constraint because it will force you to do, one, you'll be able to monitor what you have first and foremost, because if you're a trader and you're trading 30 stocks, I don't think you'll be able to sleep at night. Right? So it has to be small enough but manageable enough to be able to carry your attention. 3 to 5 stocks, good enough. If one of your stocks goes up 50%, believe me, your portfolio would feel it. But if you're carrying 30 stocks and one of your stocks go up 50%, that's like a mosquito bite. You're not going to see that. So try to be focused. You have to have that right attention to the right number of stocks. Now, in our ability to move forward in the buy a story, you could do that in 2 ways. One popular way is cost averaging. Now, this type of buying and holding strategy is simply a gradual buy and hold strategy. And that means you're going to be buying your stock, but you're going to do it little by little over time. Now, a lot of people have that and they say, hey, isn't that the way it's supposed to be? Now, there's another way to do that, which I will discuss in a little while, but let's talk about the wisdom of this particular policy. Cost averaging simply means this. You're going to be buying your stock and you're going to say, all right, I will set a certain peso value that I'd like to accumulate. If I say 5 or 10,000 pesos I want to buy of this stock and I want to do it every month or every week or every quarter or every half year, you name it. I mean, the good policy is really dependent on what you feel comfortable with. And so what you're going to be doing is you're going to carry out, let's say you decide to carry out a monthly program to buy 5,000 pesos worth of a stock every month. And let's say you pick 3 companies you want to buy and you simply just buy that over a period. Never mind what the price is on the month you are to buy. Just buy that set value. Don't get scared. Don't get excited. All right? This is not for emotion. This is just for logical pursuit in terms of activity. And you're just going to do that over and over. Now, of course, your stock will one day climb, assuming that you did do your fundamental job and pick out good quality issues. And the company that you might buy will probably go up and down, sometimes in a very big manner. And as you buy and sell those stocks, you will see that your stock might go up and down and up and down and up and down as fast as you see in there. And so it's easy to get lost up in your emotion in that type of activity. So remember, as the structure says, just buy 5,000 every month. If you were to do that in this particular program, eventually you will see that your average price will be generated as you accumulate this. And remember this, if I were to only buy 5,000 pesos, if my 5,000 pesos is buying, let's say, a certain at a certain price, let's say at 3 pesos, you will get a certain number of shares. If next month, let's say the price of your stock goes all the way up to 5 pesos and it's now more expensive, your 5,000 will eventually buy less number of shares. Do that over and over every month and you will notice you will always be able to buy more shares when prices are in the low side of the range and you will buy less whenever prices are on the top side. Because of that, your average price will look like this. And as your average price, if you notice, hoses down into the lower end of the range, there will be a point that your stock price may be going up and down when you would have accumulated good value, and eventually there's going to be a point where your average cost will be way below your price band. By that time, you'll just be sitting pretty. And so that's one way to be able to skin this cat, so to speak, because, I mean, here you don't need rocket science. You just need durability in your intent. And please don't get scared. Remember, you're buying a company that's lasting anyway. If it wasn't a fundamentally qualified pick, you shouldn't be buying that in the first place. So if you're going to be buying a stock, there's one way to do it. Now, another reason that some people have been swerving, so to speak, or coming around to be able to modify that version of cost averaging. Here's where some trading comes in. Some people have been modifying the cost averaging system, and what they do instead is this. Instead of just go ahead and buy the certain amount of allocations you have for the stock in that particular period, this time you say, all right, I will continue to accumulate the price of that stock, but only if the price of the stock is below its fair value. The minute it goes above its fair value, you stop buying, and you will wait until prices head back down. Some people will say, no, maybe we can even sell some there, and when it comes back down below its fair value, then I can accumulate it using cost averaging all over again. If you think about it, that should be able to give you much more power and ability to reap the benefits of that, because you're doing something that's more logical, because the tendency for prices is better really to buy it below its fair value. And maybe even a better sequence of that is this. Determine for yourself. Let's say you give a discount to the fair value. So I just don't want it to buy it below its fair value. I want to buy it at a way discounted value to that fair value. So for example, if a stock here is worth, let's say, 10 pesos in its fair value, the first system will tell you that if you had purchased it and the stock price goes below 10, then you would just continue to accumulate and buy it. Now one day, if the stock price goes to 10.10 and that's now above your fair value, then you would just completely stop buying and wait for prices to become more reasonable. The second system will now drive a discount to your fair. The discount meaning I want a certain amount of cheapness inside my stock, and that's the only time I will buy it. That way you don't think that you're just buying it even at almost 10 pesos, you're still buying. But in this particular case, you're demanding that the discount is big so that the cheapness is really attractive. You may have to determine that. You could say 5% below the fair value, 10%. We have in our website, we have a buy below column that stresses something between 13 and 14% discount, which is something that we'd want. In other words, if you were to invest into a company in 1 year, I think it's quite healthy for you to have a potential gain of about 14% in a year. That's what the Philippine Stock Exchange has averaged in the last 20 years. So you want to go after something like that. So that's why we want to be able to demand this. So in this particular example, if and only if the price of your stock, let's say, goes below 860, that's the only time you start accumulating again. And if it ever goes higher, then you stop. Or maybe if you want to lighten a little bit, you can lighten. But I would prefer that to maybe just stop, because the long-term prospect of your company is good anyway. All right, so this is a very simple process. You don't have to trade your stock every day. You just go ahead, buy it whenever you can, and I think this will be very reachable to anyone who begins. Now, there is a counter argument, and a lot of people will say, you know what, why would I want to go to cost averaging? Why don't I just go buy my stock one time, big time? If you mean, what do you mean one time, big time? That means instead of coursing my purchases over time in such a lengthy period, why don't I just buy it all in one go, right? Because if I call it right, I make money faster. But what about if you call it wrong? And so remember, it's all about management of risk as well, the world of trading. So have a look at this stock. So we're looking at Ayala Land's price. Now, if you're lucky enough, you do one time, big time, and you enter the market at this price. And I think it's easy to see here. You've been making money quite well. But entering the market, let's say you call it wrong and you call it from the top or near the top. And that means it's going to take you such an incredible amount of waiting time before you get it to be right. And what's probably even worse in this particular case is, let's say you buy at the high and you tell yourself, don't worry, as the stock price comes down, everybody resorts to the same reason anyway. If I buy a stock and it starts falling below the price that I bought it at, all I have to do is wait. Right? Right? How come you don't want to say yes? I'll tell you why. Because as the stock price starts to fall, and you notice, let's say this happens, and you see your stock price fall down while it's doing this, and although you told yourself, I'm just going to wait till one day this happens, and you'll probably be right, but while this is happening, you're going to be watching yourself, and every night you're not going to be able to sleep. Your palms are going to get so sweaty, you're going to get so nervous that you might be tossed out of your position. And believe me, where do you think it will be the scariest? Where do you think it'll be the scariest here? Up here? No, because it's just starting to hurt you, and that's not really anything. The scariest is nearest the low. And I will tell you right now, 80% of the people usually sell closest to the low. You want to test yourself? Well, I don't know if you're a masochist, but I would rather that you don't put yourself to the test. So what you want to do is you just make sure that your mindset is ready to be able to do that. So again, let's talk about some advantages here. The advantage of a one-time, big time is, again, easy to implement because you can carry it forward. There's no need to be able to time the market, what we talked about. It's efficient. We talk about cost. You can put money to work right now. That's the biggest advantage of it. Because I don't have to be able to wait so long to deploy the money I have in the bank. Because in cost averaging, I have to divide it and eventually leave it going. This one, I can just put it all in. But the big problem with this, if you notice on the disadvantage column, similar to what we saw earlier, but this one right here. What happens if I don't have a big amount of money? So big time could come out and be successful for you. But if you're not the type that already has that big amount of cash right now, then you obviously have to earn it first before you invest it. And so if you're in that type, automatically cost averaging has to be the way. So if you learn that, and if you do have some money now, what you can do is you can probably put in a good amount of size of position now, and whatever you earn afterwards, and you cost average the rest. In the end, cost averaging will come back. So try to understand the wisdom of what that can be. Now, timing. Now, timing is all about understanding price movement. And in order for us to understand timing in the stock market, we're going to have to delve a little bit deeper. We're going to understand the nature of price. The stock market price is a very important animal because inside that price was the result of a battlefield of information. And that means that people would have argued amongst themselves, they would have been thinking about what their analyst said, they would have read the newspaper. In the end of the day, I have to make a decision. And my decision at the end of the day is either I buy or I sell, and my buying and selling activity will influence the price. And so that movement into the price is very important. Every day in the stock market, a trader will try to be able to determine something like this. We call this a price graph. And this price graph will show you what happened in the basic trading day. Now, in the stock market, we will plot out 4 price points: the opening, the high, the low, and the close. And as we put this together in graphic form or a picture, then we will have a picture like this that will control our activity. We need to see that in picture form because we can only relate and in a very swift way to that movement if we see it on a picture. Imagine if I were to be able to draw a blackboard full of numbers. Maybe by the 4th number, you'd probably forget the rest. And so looking at it in picture form, you can be more sensitive to it because it will paint a picture that will give you much, much more meaning, particularly a trend. And so this picture that you would see in front of you is a series of those small day-to-day price movements stuck together. And now that you see them in a much bigger fashion, you can see what this market has been doing in quite some time. This is First Philippine Holdings. And in this particular graph that you see, you will notice that markets will have in availability 3 trends. And the 3 trends are either up, down, or sideways. And so these are what you need to know in the market. Which way is my market going? Is it going up? Is it going down? And if it's going sideways? Do you think if you knew the answer to that question, then life would be much easier in the stock market for you? In other words, if I were to have asked you, if the market's going up, would that be an easy thing for you? No? Or do you want the market to be going down? If the market is angling downwards, and you know what you shouldn't be doing. You shouldn't be putting that aggressiveness into the market. Just give it time. Let it come down. Let it give more attractive prices to you. If the market's going sideways, you don't have to be aggressive either. Just whenever it's on the low side, then that's when you pick it up. When it's on the high side, you sell it. And so there are certain things that we have to understand in the world of trading, and that trend factor is very important. Trends are studied by a science called technical analysis. And in our ability to gauge that, we're going to be studying a little bit more about it. But let's talk about that trend again. When a trend begins, it starts with a step, a baby step. let's call one of those steps support and one called resistance, and let me explain that. In technical analysis, we have the notion of where is this place where all of a sudden a huge amount of buying has been generated, an area of interest of buying that is so heavy that it stops prices from going down. We call that area an area of support or an area of intense buying. If there is an area people want to buy a huge amount of shares of, then more likely the price will not fall below that area. And we will graph that out into a price chart by looking at these low points in our price graphs. As prices move up, eventually a huge amount of profit taking is going to take place. And as these people want to sell their stock, it's going to stop any advance because there's too many sellers that are standing in my way. We call that area an area of resistance. And in a graph, we will point out most of the highs you would see as an area of that resistance. So an area of support, heavy buying. An area of resistance, heavy selling. What do you want to do? Do you want to buy where there are a lot of buyers, or would you like to buy where there are a lot of sellers? Which do you think will lead to better movement for you? Of course, where there are a lot more buyers. If you're going to buy in a place where all of a sudden there are a ton of sellers in front of you, then your stock price has a very, very small chance of moving higher thereafter. You need to buy where there's good demand. And you want to sell it eventually where there's too heavy amounts of supply. And so this is what we do when we come around to be able to use technicals. We will identify where are these points of support, where are these points of resistance. Like I said in a price graph, we will draw the low points as support and the high points as resistance. Sometimes when the trend becomes more intense, you will see now that instead of moving sideways, they will now angle slightly upwards. And if you notice, the areas of support are climbing and the areas of resistance are also climbing. When you have these two moving in the same direction, then obviously a trend has been generated. And that's what we want to be able to pick out from these. And so the trading idea when we have if we identify an area of support and resistance is this: buy closer to support, sell closer to resistance. Or buy closer to where there's huge amount of buying taking place and sell it where you know there's going to be a lot of sellers taking place. And I guess that makes logical sense. If you come around to be able to look into those bigger trends and you say, all right, so what do I do now? Once I see that the trend is being manifested, how do I go inside and take part of that? Now remember, in technical analysis, they say a trend is your friend, and you're supposed to stick with it as long as possible. And don't second guess whatever you see. And if the trend continues for the next 2 months, follow it. If the trend continues for the next 2 years, follow it. Don't come around and say, this market looks crazy and it looks like it's about to collapse. You just stick with it as long as possible. You might be wrong, right? We are human. We make mistakes too. We could overestimate the situation or underestimate the situation. So you don't want that to happen. You just make sure that you stick with your guns and make sure that the plan comes out to be. So in this particular drive, we will now look for, let's say, a particular aid in generating our ability to stick with things. And so we're going to use a tool known as a trend line. A trend line is a line like this, or a line like this, and the blue line that you see here. A trend line is a line that we will draw to follow a trend. That's why we call it to be a trend line. An uptrend line, those that you see in blue, are drawn by connecting the lows of your graph, as many lows as possible. And after you draw that line becomes a line of support. And anytime you see that there is a pullback from prices up here going back down to your trend line or to that supportive line, then that is your next opportunity to buy. If the price of your stock, like this or like that, is too far from your trend line, you don't buy there. You wait for it to come back down to your trend line. How many times you call your broker and you see the stock price going up, you scratch your head and you probably tell him, oh, what do I do? Can I still buy that stock? And maybe your broker might say something else. He might say, maybe it's too high. Maybe you want to wait. And he's saying, what's he waiting for? And this is what we talk about, a correction, a pullback in the price. And we'll talk about that in a little while. Just remember, once you get a trend going, you want to be acting where the point of support is the strongest, not the weakest. And it is weakest the closer it is to resistance. So you will be buying closer to where this blue line is, and you will stop buying when you see that it is too far away. Particularly, look at the distance up here to where that blue line is. You're asking for trouble in getting into your stock. So if you're talking about timing, don't ever run way ahead of that trend line. All right? And you got to wait for things to be able to calm down. When markets are falling down, a new trend will take effect, a downtrend. And a downtrend line will be used now to be able to gauge a declining trend. And you will draw a downtrend line by, instead of connecting the lows like the way we did here, you will connect the tops of your graph. And as you connect them and you see that the declining trend has come to manifest, it is not your business to buy a single share of your stock in that decline. Why? Because we assume while it is falling down that it could continue to fall down, and while that trend is pointing downwards, who knows how low it will be. I have seen a stock price go down and down and down and down and down and down still today. And so you just want to make sure that you give it the benefit of the doubt. The trend points downwards, don't tinker around with it. One day that trend will shift. When that trend shifts, your activity is necessary again. So for example, when you get the condition that this red line is broken and you see prices are now angling up and you see lows followed by higher lows and higher highs and the trend has now swerved back up, it's time for you to buy your stock back. So it's okay for you to be able to generate certain buy signals whenever you see prices falling back down to your trend line. So in other words, this is a buy, that's a buy, this is a buy. All right? And you will hold whatever it is that you buy as long as the trend continues. So for example, if you had bought this, you will hold this through and through, and you will not sell your stock until this trend line is broken. Once the trend is broken, like you see here, then it's time for you to press the exit button, because the trend has changed and the ability for it to climb has now been brought to suspect. So take your position out first, or at the least lighten down. Wait for the next opportunity to buy your stock back, or if at all, and don't be letting your hands get too itchy on the way down. Let it go. All right? So it's not our job to guess that. Remember, I'm not here to teach you to buy the absolute lowest price in that graph, because it's near impossible to do. Very impossible. So what you want is you want to make sure that the price shows you enough turnaround ability for it to reverse the trend and tell you finally the trend has finally gone back up. And when the trend is finally back up, you go ahead and start buying your stock and accumulating it and holding it as long as the trend manifests. When that trend line cracks, the only decision you're going to make is to follow. And follow means to sell. Because once that uptrend line is no longer in effect, you're in a sense telling yourself, why am I holding my stock if it's not going to climb up anymore? So let it go first. When you toss a tennis ball up into the air, is it going to fall back to your hand? Will it? Well, you know it does, because there's gravity. And believe me, there's gravity in the stock market as well. And with that, knowing that, then you should just wait patiently that there will be another opportunity that will knock on your door. So, in our ability to be able to generate these movements, you have to take notice that just like human beings, your stock market needs to rest every once in a while. It gets tired. And that's what we call a correction. A correction is a phase that the market will have to go through to rest, gain more energy, wind up again, and eventually move. But in that corrective process, your market may do one of two things in its ability to do that. Well, why does a market get tired? Well, a market gets tired because who buys stocks if not people like us? We're human beings. Do you think we can get tired for making money? Never experience it. Well, one day you will. And I will tell you, it can be quite tiresome to be a trader and to be able to move in and out of a market, especially when volatility or ups and downs come in. But I will tell you what will happen. There is a law in the market, and the law in the market states this. It takes time for prices to move a certain distance. That's the law. If there is an exaggeration to that, in other words, let's say you're seeing a stock price move up and it's starting to move up very, very quickly, that is what we call an exaggerated state. Let me show you an example. Let's say this is your trend line. This is your trend going up over in time. But instead of going upwards in that pace, all of a sudden your stock price starts to rise much faster like that. And as your price moves up so quickly and it goes up to this particular phase, what happens if your stock movement gets tired? Too many people are coming in at the same time. Eventually, everybody who wanted to buy that bought it. And where you're in that area of saturation, or too many people bought your stock already, and it cannot climb up anymore, where do you think it's going to go? Well, maybe not down, but obviously not up anymore because it's fulfilled what you've already managed to do. So your market has two options thereafter. And this exaggerated market, in our language, we call it an overbought market. An overbought market is a market that's gone up too fast, too soon. And when that happens, the only alternative is one of two. One, your stock price will move sideways for a very long time. We call that a consolidation. So when the market starts to be able to move sideways, it's because it needs to be able to regain energy. I've lost it, I've spent it in that advance, and now I have to somehow wind up again. And until that winding is finally accomplished at the full state, your stock price is not going to move. And that's why some stocks you would see, wow, it takes forever for them to move sideways because it's trying to gain energy slowly. Another way to fix that problem and fix it faster, and instead of moving sideways for a very long time, you could fix it faster by allowing your price to come down. And that means instead of seeing the first state where you would just go sideways for a very lengthy period, your stock price will now adjust downwards. That's what we call a correction. We call it a correction because it's correcting something. What is it correcting? Exaggeration. Once it's corrected enough, then your stock can finally go back up. And now that will make sense to you. And now you will see more logical sense. Why does the market go up and down and up and down and up and down? And the reason for that is the logical one that you see over here. So what you want to sense right now is don't buy too far up from where these prices become too extended. Wait for prices to come back down because there is gravity in markets, and you will see the logic of that in this picture. Here is an example of a stock price that climbs up over time. But as it climbs up, look at the rockiness that you see. Up, down, up, down, up, down. My God, like a yo-yo, and here you go. And it can be quite an armful to deal with. It's like sitting on top of a horse that will try to buck you off its back. And so this particular type of movement, look at it in the very first state, and you can see, wow, what a hectic condition. But look what happens when I put a trend line in there. Do you notice something? How come every time it pulls back, it just happens to be where the line is? What does that line have that stops the price from going down? Very good, support. In English, demand to buy the stock. And there's much healthier demand there than there is up here. And up there is what we call that overbought market, that people bought too much, and so you want to wait for prices to be able to come down. And these are what corrections are for. So corrections pull prices backwards so that they can take you off that exaggerated condition of being overbought, and it will drive it back down to your trend line so that it can point out a better opportunity to buy. And I guess that is your very, very first sense of credible technical analysis telling you, wait for prices to come down to the right time. Technical analysis is always activity at the right time. You cannot tell me, is this the right price? Is this the right price? We don't wait for the right price. We wait for the right time. We don't care the price we buy. Would you care buying a stock if I tell you right now, the stock's fair value is at 12? But I'll tell you, let's say it's going to go up to 20. Would you care buying it at 12? No. Would you buy it at 13? Yes. Would you buy it at 14? Yes. Why? Because I just told you it's going to go to 20. And so if you just have that sense that you know it's still going to move up, I don't think price is going to be too material. Right? So I don't want to go against what I taught you earlier, that I'd rather you accumulate stocks at good fair values. But understand, once a trend takes into effect, believe me, it's so hard to stop. And that's why you want to be able to go with the flow. Now, in our ability to understand these patterns a little bit more, is there any type of use that we can come out with this? Now, these particular types of patterns, markets will go sideways. And remember, I want you to think when markets are consolidating, they're going up and down and up and down, it might just look a little crazy. I want you to imagine that you're holding a wind-up toy in your hand and you're winding it up with a key. And as you're winding it up, it's gaining that potential energy inside it. And there's going to be a point where after it's completely wound up and you let it go, that thing will rip right through. And so what you want to wait for are those opportunities when prices launch themselves away from that consolidating band, that sideways move. Because the minute they take off, that means it's time. Time for me to move again. And you can jump back and buy that stock when you see that occurrence take place. We call that push out of a consolidation a breakout. And a breakout tells you it's time to buy back. And when you buy your shares, hold on to it for the meantime, because what you're about to see may be quite a bit of a push upwards. And in our language, in technical analysis, they will tell you that the minimum upside you will get of a consolidation is the size of the consolidation. So if a stock price went up from 8 to 10, and 8 to 10, and 8 to 10, and finally it goes above 10, it will go up by a distance, 10 minus 8, 2. Add that to 10, it'll go up to 12 pesos minimum. And so these are the things that you can learn in technical analysis. Now I'm just going to scrape off the tip of the iceberg here just to give you a sense of what eventually you can learn with that. But technical analysis is a good timing tool that can help you do that. Now what happens if things go sour? Let's say instead of it going from 8 to 10, 8 to 10, 8 to 10, all of a sudden instead of going above 10, it goes below 8 for heaven's sakes. That means the buyer could not hold the price anymore. And that the buyers probably lost enough money and they couldn't take the position any higher anymore. And when that happens and prices start to fall down, more people start to lose money and more people start to get agitated. And as more people get agitated, the more they're now going to be induced to sell. And the more you get the crowd to sell and they're more behaving like a crowd, it will create a new trend. Not an uptrend, a downtrend. And that's why whenever that support structure breaks, whenever these low points are broken, we call that a breakdown, and that means it's time for you to get out of a market. So we just move in and out of a market based on that particular type of motions. Remember, your stock needs to pull back every once in a while. So don't think every pullback is very wrong, but just sit still as long as the trends are very much in order. Now, I want to be able to show you what a typical trader will go through. So let's look at our famous bumblebee over here, and let's see how we will be able to look through it. So this is Jollibee. And I took the liberty of drawing a basic trend that Jollibee was generating on the onset of its movement, and let's take it one step at a time. Based on what I just told you, is the price currently up here, is that a distance to your trend line? Is it big or is it small? Big. Is it a good time to buy? Let's see what happens. Did you notice what happened in the two occasions? It fell back to its trend line. Would this be a better time to buy? Yes. When it goes back up here, do you buy? No. When it comes back down here, what do? You buy. Do you know how to buy now? And let's look at it over and over again. Time to buy? I only heard one guy answer. Time to buy? Time to buy? Easy. Yes. Believe me, the big decision comes when your money is there. When you do paper trading, just like what we're doing right now, we're just throwing a concept and it seems so easy. And you're probably going to go home tonight and say, wow, I talked to this guy, he just made it sound so easy, I'm going to do this the very next day. Try it yourself. And that's why we have to build the discipline. Because emotion has to be launched out that door. The minute emotion's in the back of your head, this will all ruin itself. And that's why we have to make sure the trading concept is simple. You can learn more about technical analysis. It can give you more of this. You should learn more about fundamentals to qualify your issues more. And these are the two sciences that you spend yourself time evaluating more and going through some more. So in this particular prospect, the last stage now is execution. You have all the plans in place. Don't buy way up there. Buy it closer to support. Just make sure that my issues are all qualified very well. But you have to understand that execution is also very important. And if it says here, knowing others is intelligence. Knowing yourself is true wisdom. Mastering others is strength. Mastering yourself is true power. If you realize that you have enough, you are truly rich. Does that make sense to you? And that statement has a very, very loaded message. Because that thing is trying to tell you, if you get carried away from the market and you start coming inside and you had bought Double Dragon, it's at $10 already, and you're saying, Kwarta o kahon? Right? Is that something that we deal with? Company just went IPO, it went all the way up. Believe me, there's somebody laughing right now. Of course, everybody who's holding it is still laughing, but the company owners are laughing double time. And eventually, there's going to be a point they know the value of their business. You don't. And that's why we, because we don't know the value, are all hitting it and hitting it and hitting it, thinking that's going to 20 or maybe going to 100. Like a stock once I saw in history go to 107 from 1 pesos and then fell back to 37 cents. Now, I'm not saying I'm not forecasting this going back to 37 cents, but please be aware, there will be a point where it has to stop. And by that time, I sure hope you're not the last one saying, I have to press the exit button. Okay, so just be mindful of what needs to be because we're way over where you're supposed to be. Now, let me just leave you with this particular adage. Right mind, right action. And this is what a trader must understand. When a trader builds his skill, he's like a sword, a samurai sword. When you build a samurai sword, it goes through a process of intense hammering. When you forge that sword, you put it into the fire and you put that blade and you pound in it and you pound in it and you fold the metal, pound in it again, fold the metal, and you do that because it builds what we call tensile strength and the sword becomes incredibly sharp. But after all that hammering and folding and forging that you're doing, eventually that particular sword will have to cool down. And I'm going to tell you what that will mean in trading. Every once in a while, you got to learn how to step back from your trading terminal. If you're having a difficult time in the market, step back. Why do you think we have places like Boracay to go to? Take a break. You need it. And you need it not just to be feeling good time, but you need it to be able to reassess what you're doing. Because sometimes you become too close to the market that you have to have some time off to think about what your logical pursuits are. Think about your mistakes and go back to it and deal with it with a much better mindset. Remember this. You cannot solve a problem with the same mindset that creates a problem. So you have to clear your mind, in other words. And so you have to be able to step back. And that's what creates a fantastic trader because you learn from your mistakes. Because if you make a mistake right now, you lose money. If you lose the same amount of money creating the same mistake, shame on you. Because you shouldn't have. You should have learned that particular problem already. Okay, so try to be able to build in that. Now, step one, always have a trading plan. No trader leaves home without it. And the trading plan should be able to conquer whatever other mind problem you might have. That plan sticks. It says here, know your entry and exit conditions. Buying closer to support, that is an entry condition. Coming towards resistance, that could be an exit condition. If it breaks your trend line, exit condition. Right? And there are no questions about that. It has to be followed. It's a guide. And that's what you would learn in the science of technical analysis. Estimate your downsides and upsides. So when I come into a particular market, I want to know roughly what is he trying to be able to give me potentially. And then, just in case I'm wrong, where will it fall down to? And can I tolerate that? If the answer is no, then up to where can I tolerate? And you have to identify where those places are before you buy your stock, not after. So when you enter a stock position, you know two things. Where do I expect it to go? In case I'm wrong, where will it go down to? And what will that area be that I will call this off? Because you cannot buy into a stock and have an open manhole waiting for you right there to fall under. There must always be protection, and that's why the plan is essential. 2, treat trading like it were a business. Now, I know a lot of you buy your stock position, goes below your price, and you're just simply going to rely on one adage and says, hey, as long as the price does not go above my purchase, does not, or stays below my purchase price, and I simply won't sell it. If I don't sell it, I don't lose. Anyway, I can always say, I'll just become long-term. Right? Isn't that the normal recourse? But believe me, we call that the loser's game if you are a trader. A trader does not work that way. He has a fixed set of rules. If it breaks this price, I'm out. Risk is always stipulated. Try to understand, if you have that dead set system in, how can you lose big money in the stock market? It cannot happen. Because you've already identified what the maximum loss even before you bought it. All done, pre-assessed. And you can take that to the bank. Now, when you treat into business, and just to put more clarity in here, if you buy a particular stock, it starts losing money. Okay? And I know you become so scared to liquidate that business. Let me ask you, instead of you buying a stock, think that you really bought a business and that you started your own business. Okay? If your business does not make money in year number 1, what will you do in year number 2? Do I try to let the business grow again? I was not profitable in year number 1. Do I give it a try again? Why not, right? Who knows? Maybe it was just misfortune. So I put more money, let the company run again. I try it for year number 2. I lose money again. What now? While you're thinking about it, year 3 goes by. You lose money again. What now? Still thinking about it? Year 4 goes by, you lose money again. And that is emotion. You can't get out of your problem. Ladies and gentlemen, when you try a business and it's not working, and you gave it all you've got, and you've given it all your know-how, and you give it enough time to work, and it doesn't work, don't you think it's time for you to sell your business and look for another plan? Sell it. Raise whatever capital you have. Try another business. Unless, of course, your desire is to ride this all the way back down to 0. And if you're going to do that as a logical pursuit with a company, then why not do it with its stock? It's the same. It's the same. And that's what you have to understand. Treat it like it were a business. If you treat it like a business, I think you'll probably do the right thing more rather than treating like it were a stock. Devote time, study, and practice, and expect pitfalls along your campaign. Learn and improve on it. So this particular statement simply tells you that as you're running inside and you're running any ordinary business, when you come into a run a business, you will do your own field research. You will check to see what the industry is like. You will see what the risks are. You will see what the potential for a business to make money. And you should do the same thing in your stock. Do your research. Read the company. You already have access to those reports anyway today. You can check its fair value. Look into the quality of a business. And if you think that things down the road are not looking as good as what you thought, you can always lighten up. If it's coming up to that point that it looks really bad, take it out of your portfolio and look for something much better. You don't have to keep yourself in a stock as far back down as possible. You might be right, but you might be right 10 years from now. Anybody know the story of Cebu Air? The IPO that came out, an airline falling straight down and down and down and down. And only nowadays, it's only nowadays that it's finally starting to resuscitate itself. And you might say, for the guy who held that for I don't know how many years now, maybe 7 or 8 years maybe? And now you're saying, wow, I'm finally right. In that 7 years, you could have been making a huge amount of money elsewhere. And maybe take your profits there now, and now only you can buy it back if you'd like. And that's the way a trader's life is. He will not miss out on the opportunity. He will always be where the opportunity is. Don't you think there's more money there? Watch your capital like a hawk. Remember, this is your ticket into the game. No money, no honey. And that means this is like a diver who goes underneath the water and he's got his scuba tank on. Inside he's got his most precious asset, oxygen. And inside that particular scuba tank, some people challenged me once. They said, it's not just oxygen, there's oxygen and nitrogen. All right, you can put them both if you like. But whatever the case is, if you don't have your ability to breathe down there, you're in the wrong environment. So watch your capital like a diver watches his O2. And in that capacity, you can see much more limelight into what you're about to do. And finally, you really only have one enemy here. You only have one enemy. It's not your stockbroker. It's not your internet. It's not you not having any education. It's not whatever you think your parents did to you, in case you do. Your one enemy is yourself. You are the biggest drag in your account because it is your emotion that will fight you every day of your life. And so somehow you're going to wrestle with him and you're going to put him in check. And you have to tell this guy, hey, come on, stop bugging me already and let my logical mind take control. And emotion has to take a back seat here. He cannot be the driver. Because you cannot come around and make good decisions when you're emotionally induced. That is what a trader needs. He needs to be liberated from that emotion. And by doing that, he has to be able to make sure he stays on that right mindset. Right mind, right action. And that is the fullness of what you have here. Now it says, always know when it's time to stop. Many times, when I don't know what I'm doing anymore, I will stop. I'll take a few days off. I will just come inside, concentrate on the business. I'll stop trading. Because you need it sometimes. You got to be able to free your mind. You need to cool down. Just like a car needs to cool down when it overheats, you sure need some rest too. But remember this. You cannot put yourself in the point of panic. When you're too scared, please look at that last statement there. It says, scared money will never make money. Yes, investing money is risky. It doesn't matter what investment that is. Stocks, bonds, currencies, commodities, mutual funds, UITFs, insurance, property, you name it. Anything that can be invested in has risk. It is the proper management of risk that changes everything. When you put everything into the proper aspect, into the proper aspect of control, you will be able to keep yourself in investment that can yield a lot because you are the one limiting the risk. And that's what it is. Do you think any billionaire out there made his billions without taking any risk? By being too fearful of what he's doing? Don't let it paralyze you. You gotta, like I said, liberate yourself with that emotion. And we have to put our stake out there and challenge ourselves. And that's what the life of a trader is. And so I hope that part of these things that have come up, like I said, I know this is just a tip of the iceberg, but in this 1 hour's time, I hope that I've managed to put some trader sense into you so that you can see what you're going to still have to learn a little bit more of. But what I told you, remember, buy closer to support or your trend line. Don't be buying way off above it. Because when you see those surges, you're asking for a very, very, very sad story to come if you're the one buying all the way up there. Believe me. I know what it's like to buy in the top. I know what it's like to sell in the bottom. Do you want to take my word for it, or would you like to try it yourself? Unless you're here because of excitement. If you're here because of excitement, oh, please go ahead and do that. But let me save you a whole lot of money. I paid my dues in the market by following strict rules. Took me time to learn it, and I think it might take you some time to learn it, but practice it, live through it, because that's what creates a phenomenal trader. Remember that samurai sword. You're going to have to be burnt a little bit, you're going to have to be folded a little bit, and you're going to have to go through the process of getting hammered once in a while, but that makes you all a tougher investor. It makes you a tougher trader. In the end, you will be the one surfacing out. Just like that bright samurai sword, you'll be able to carry through and you'll slice yourself over every market anytime that you want. So ladies and gentlemen, thank you again for your time, and I hope I've managed to give you some sense of what a trader's life is like. Thank you very much.